Currency devaluation is a frequently discussed financial term, though its implications are often not fully understood by the general public. This economic maneuver holds significant power, reshaping economies and individual financial realities. This video will explore the mechanics, complexities, and unseen consequences of devaluation, revealing its true societal impact. At its core, currency devaluation is a deliberate act, not merely a market fluctuation. It represents a policy decision, meticulously made by a nation's central bank or its governing body. The explicit goal is to reduce the value of a country's currency relative to other international currencies. This decline is typically measured against a carefully selected basket of other major currencies. Alternatively, it might be benchmarked against a specific, globally dominant currency, such as the US dollar. Devaluation is fundamentally reflected in the exchange rate, directly determining how much of one currency is required to purchase another. One primary driver behind a government's decision to devalue its currency is to significantly boost exports. A weaker domestic currency makes a country's goods and services considerably cheaper for foreign buyers. This increased affordability can lead to a surge in demand for exports, aiming to stimulate domestic economic growth. The economic consequences and impacts of devaluation are far-reaching and complex, affecting various facets of national life. Firstly, devaluation directly impacts trade dynamics by making imports significantly more expensive. This increased cost of imported goods, especially raw materials or essential consumer items, can directly lead to inflation within the domestic economy. As the prices of these crucial imports rise, they inevitably impact the prices consumers pay for everyday necessities, reducing overall purchasing power. The impact on businesses is notably multifaceted, creating both winners and losers. Exporters generally benefit immensely from devaluation, finding their products more competitive and demand increasing in global markets. This can lead to higher revenues and expanded operations. However, importers face a significantly different reality, confronting higher operational costs due to the increased price of foreign goods and components. Businesses across all sectors must rapidly adapt to these sudden and profound shifts in the economic landscape to remain viable. For individuals, currency devaluation often erodes their hard-earned purchasing power. The cost of living rises as imported goods become more expensive, and domestic prices often follow suit. Wages, unfortunately, typically do not keep pace with this accelerated rate of price increases. This disparity leads to a tangible decline in living standards and can cause significant financial hardship for households. Savings also diminish in real value, further straining personal finances. Investors, too, keenly feel the effects of devaluation, often with considerable anxiety. The value of domestic assets, including stocks and bonds, can be severely negatively impacted as economic uncertainty grows. This erosion of asset value makes the market less attractive. Such conditions can trigger a phenomenon known as capital flight, where investors swiftly seek safer havens for their money in more stable economies. This exodus further destabilizes the devaluing nation's financial system. Governments frequently employ devaluation as a strategic tool to manage their national debt, particularly debt denominated in foreign currencies. A weaker domestic currency can make it numerically easier to service this foreign-denominated debt, at least in local currency terms. This offers a short-term, albeit superficial relief to strained national budgets. While this strategy may provide some immediate fiscal breathing room, it comes with a distinct set of inherent and often severe risks. Devaluation can swiftly trigger widespread social unrest, fueled by rapidly rising inflation and generalized economic instability. Public dissatisfaction can quickly escalate, leading to significant political instability and, in severe cases, social upheaval. The broader implications and nuances of currency devaluation reveal a highly intricate economic landscape. The actual effectiveness of devaluation is never guaranteed and fundamentally depends on various interconnected factors. These include the specific economic structure of the country, its established trade relationships with other nations, and the prevailing global economic climate. There is no universal, one-size-fits-all solution, or a guaranteed positive outcome when a currency is devalued. Surface-level assumptions about devaluation often dramatically overlook its profound complexities and interconnectedness. It is not simply a matter of making a nation's goods cheaper for export. It involves a sophisticated and often volatile interplay of economic forces. The long-term implications of devaluation are consistently significant and often challenging. It can inadvertently lead to a destructive cycle of inflation, potentially requiring further rounds of devaluation to maintain perceived competitiveness. This insidious cycle progressively erodes trust in the national currency and, by extension, in the government itself. In our increasingly globalized world, currency devaluation has far-reaching consequences that extend well beyond national borders. It affects both the devaluing country and its myriad trading partners, creating a complex ripple effect across the entire international economy. The actions of one nation can send tremors through global financial markets and trade relationships. The modern economic landscape is undeniably complex and constantly evolving, presenting new challenges and opportunities. Currency devaluation is merely one instrument within a vast arsenal of available economic policies. Its ultimate effectiveness and its true consequences are always subject to intense debate among economists and policymakers alike. Understanding currency devaluation therefore requires a deeply nuanced perspective and a critical examination of its intricate mechanisms and broad societal impact. It is a profoundly complex phenomenon, reflecting the intricate dance between governments, dynamic markets, and the everyday lives of ordinary people. The true cost of devaluation is often hidden behind economic jargon, but its profound impact is invariably felt by everyone.